Hello everyone. Now we are going to look at the types of trades that you do in the market before we proceed. Now the trades can either be a buy order or a short sell order. A buy order is where you do not have shares and you say you want to buy the shares and own them. So in other words, when you place a buy order, usually you are saying, I want to have shares in company X and be able to earn a dividend, or I want to have shares in company X and be able to gain when the share price moves up. That is what we call a buy order. Usually you hear people saying, I am going long. They can also be called long type of orders because you are buying today at a price which you believe is lower, hoping that it will go up and you'll be able to sell at a higher price. The other type is a bit complicated type of trade, which is called a short sell. Now, short selling involves selling shares today at today's price, which you do not own. Now, how does this happen? It happens through borrowing shares from your broker or whichever platform you use for trading in shares. So you are going to say, I'm borrowing 50 shares from my broker today and I'm selling them at the price that is happening today. Your goal in a short sell type of trade is that the price should go further down. So for example, let's say a share is $100 today and you bought 5 shares. It means if you sell them today, you're going to get $500. If the price of that share goes down further to $1, it means you can buy those borrowed shares for a much lower amount. Say, for example, you bought shares that you sold at 1,000. Now today their value has reduced to $100. You can buy them back at $100. The difference of 900 would be the profit that you would have made. Now your broker is not interested in the price that is prevailing. All he just wants is the quantity of shares that you borrowed to be returned to him when you're ready to return them. Now there's a risk that those shares can be demanded back before the price goes down to where you want. In that case, you would have to return them. Now these orders can be executed on different bases. There is what is called a market order. Now a market order is whereby you place an order and say, I want to buy shares in company X or sell shares in company X at the prevailing price of the market. So as soon as that order goes through, you get a confirmation that your order has been executed and you are now holding the shares that you have requested. Then there's what is called a limit order. Now a limit order places a restriction on the price that your broker can be able to buy or to sell at. So a limit order, you say, I want to buy 100 shares in company X, and the price that I want to buy it is $1. So your broker is going to go into the market and say, I'm looking for shares of 100 in quantity, and I'm willing to buy only at a price of $1. If there's no one who is offering shares for $1, your order will not be filled. It will remain in the market until there's somebody who comes up and says, I want to sell shares for that price. Now, a fill or a queue type of order is one whereby if you are not able to find the exact quantity and the price that has been requested by the customer, no trade is going to take place. So either you fill the whole order at once or you queue. If they cannot fill that order, they will return it and say there's no price in the market. End of day is also an instruction you can place to say, I want to buy the share at the price that will be at the end of the day. Some people do it because at the end of the day, the price would have reflected the almost what can be called an equitable price for that day. So some people say, no, I want to buy at the end of the day. That's why if you look at most share charts, The volume at the end of the day would be much higher than during the day because many orders will just be filled all at once before the market closes. Now, a partial order happens whereby your order is not fulfilled 100%. Suppose you place a limit order for 1,000 shares at $1. Your broker goes into the market and finds 300 shares at $1. He's going to buy those 300 shares and put them to your name. Then he's going to wait again until he accumulates 1,000 shares. Now, if the day closes without him finding the 1,000 shares, the 300 shares that have been bought are going to be put on your account. Now it becomes a partial order because you wanted 1,000 shares, but you ended up with only 300. So these are the types of orders that happen, and you need to be cognizant of what each of these types of bases mean. I would encourage you not to place market orders because a market order usually opens the door for your broker to add a certain amount to the price. Say, for example, you want to buy shares and you say just buy it whatever price is in the market. They can add maybe 50 cents to the share price and go and execute a transaction on your behalf at that price. Then they go into the market and buy them at a different price so they can make a difference, which is called a spread between those two amounts. So always try to go for a limit order if you can, because these give you a price that you want so that you are not prejudiced by the broker. Thank you. We'll continue to look at trends in the next video.